Hey, Puppy Trades! I wanted to do a video analysis update on a new position I've been taking. The position's probably in the title or the description. It's about a third Coinbase. It's about 2/3 a new Yieldmax ETF called CONY. I'm gonna get into it. Don't worry. But I think I have a little bit of like a monologue to give. And I know you guys love my monologues, right? Because a lot of people, when I start monologuing, they're going to say something like, stick to stocks, right? I always hear stick to stocks, right? Well, I was sticking to stocks this week. Like I promised you guys I would stick to stocks. I swore, right? And Hawaiian Electric is on a screen for unusual options volume. Now, I've talked about this screen about 2 times before. So for this screen, it's a little fair. Oh, this is a red herring. Okay, I've talked about this screen twice. We're going to get into a different screen that I talk about all the time. Don't you worry. But this screen is under bar charts unusual options volume tab, right? So what I'll do is I'll get this screen, and then before I refresh it, I'll filter it by IV rank, okay? So, if you don't know what IV rank is, that's the relative measure for implied volatility, which is another way of saying, not to oversimplify, implied volatility roughly translates as a synonym to the option price, right? The relative price of options is measured by implied volatility. I think that's a safe statement to make, right? So, what I usually am doing is I'm actually looking for these stocks up here, right? Because these stocks with 0% IV rank and percentile, those are usually the ones that the MMs, they're real quiet, right? They're really kind of quietly trying to buy this, right? While it hasn't moved in a long time. And this is conveniently when option prices are the lowest, right? So retailers forgot about the theory is that retailers forgot about these stocks up here. The institutions are taking a lot of notice of it. And this green number right here measures the 1 month percent change in options volume. So I was looking at the screener. It's part of my routine. Hawaiian Electric is at the bottom of it. And I noticed, it's roughly 63% puts, right? It's roughly 63% puts on Hawaiian Electric. And notice that the IV rank is at 100%, right? So this is the most expensive that options prices have been. And I can actually go to one of my tabs. I'm not going to do it in this video because I might mess up the video. One of my tabs, I can actually see the historical, all the history of Hawaiian Electric's implied volatility. But in the past 52 weeks, we can see that it was at the top, the top most expensive options. And institutions are buying a lot of really expensive options, right? And that's what's kind of weird is the institutions shouldn't really, ideally be buying options, kind of strangles and straddles, and puts even, especially puts, when implied volatility rank is at 100%, right? That's usually not something that you do because that's when options are most expensive, right? The options market is already pricing in that there's going to be a huge move, so it's usually a losing trade, right? Usually it's not a good idea, right? So I kind of was like, whatever. But with all these puts, what's this allow them to do? This position is biased to the downside, right? We can see this position is biased to the downside. And a lot of traders, they're going to say, okay, well, that means that Hawaiian Electric is going to crash, right? And Hawaiian Electric has fallen since it's on this. But it also means something a little different. It means that after Hawaiian Electric falls, there's a few things institutions can do to lock in that position, and we've seen evidence that they're doing that right now. So we're going to get into that evidence. But before, one of the other things they can do is they can just buy shares against these puts, right? So these puts become deep in the money, right, after they're bought. And so what can happen is that the delta is very heavily biased to the downside, right? So the institutions probably, if they're smart, are going to have to try to offset that delta, right? Or otherwise they have an extremely big put position with high implied volatility, and they've got no way to lock it in, which we'll show in this video. They did lock it in. We're going to get to that. But what they can also do is they can buy shares against those puts to help offset the delta, right? So a put with a negative 75 delta would take 75 shares bought against it to be delta neutral, and that's especially useful when the put is in the money, because then most of the put's value is intrinsic value. Okay, so we'll get into a little more of this. I just want to talk about Hawaiian Electric just for a little bit because it's an important example. It's a good example. People have asked me about this gamma scalp idea, right? So Hawaiian Electric pays a 9.88% dividend, right? That's a pretty big deal, and it's mostly because it's had this huge correction, right? And so is this dividend safe? Obviously, we don't know. Obviously, the big risk is that this dividend probably, is going to need to be looked at. There's even news saying that somehow Hawaiian Electric played a role in this. That's an actual article I read. Don't take that as fact. Do your research. But 9.88% dividends. So when the institutions have all these puts, there's a few ways they can lock it in. And when the stock pays a dividend, buying shares is especially a useful method. But what's another thing that they did, and that we're actually seeing them do right now, is that as Hawaiian Electric falls, they're buying strangles on this. So everyone knows about this screener. Okay, if you watched my channel and you took a shot every time I said bar chart, straddle, and strangle screener, we all know you'd be in the hospital. Okay, everyone knows that because I talk about this screener all the time, right? And so what happens is Hawaiian Electric falls, and then what? They lock in that downside position, right? So now they're taking another position, and notice this one too has a, I'm going to assume because the put's a lot closer, this one, the put has a delta of -30, and the call has a delta of 27, so the put's more biased. Again, they have more downside exposure, so what can they do to offset it? They can buy shares against it, right? And then again, as Hawaiian Electric falls intraday, we see it once more on the straddle and strangle screener. Sorry. So when we originally saw Hawaiian Electric on the screener, it was I think this picture was taken on Tuesday. So this picture was taken on Tuesday, and then these pictures were taken Wednesday and today. So this one was taken today, where they're buying the 10 strike put and the 17.5 strike put. And then before they bought that, before Hawaiian Electric fell, they bought the 12.5 put, and they paired it with the 22.50C call, right? So the idea is that as Hawaiian Electric is falling, first they took a negative position. In my opinion, is that they are buying shares of Hawaiian Electric as it falls to offset this negative put delta. And that's going to allow them to do a few things. It's going to allow them to, one, safely accumulate Hawaiian Electric, but also accumulate the dividend risk-free. And what's the other aspect about this? They don't have to have a stop loss, right? So as retail is stopping out of this stock, right? That just, I haven't done too much research on it, but it sounds like it's somewhat of a monopoly type of thing where it's, one of the biggest electric utilities providers in Hawaii. There's talks of restructuring, there's talks of uncertainty, and that's always going to be the case at the bottom. But the point is, institutions don't have to do that. They are using options right now, and we can see them doing this. So as people are suffering in Hawaii, as this very serious kind of phenomenon is happening, we can see large institutions have taken 1,000% higher options volume than the past month. And I've been looking at the bar chart, straddle, and strangle screener every day. I promise Hawaiian Electric has never been on the screener in the past 2.5 years. I can testify to that. Hawaiian Electric has never been on the screener in the past 2.5 years. Neither has this one. Okay, the strangle screener. I don't know why I said neither is this one. It hasn't been on these screeners in the past 2.5 to 3 years I've been studying them. Now, during the time of crisis, even while implied volatility is really high, we can see the institutions are taking biased downside long gamma positions to accumulate one of Hawaii's largest electric and utilities providers during a time of crisis, and they're doing it with a very sophisticated option strategy that suggests because the implied volatility is so high, they kind of have to know how this is going to play out. Right? And so they probably do. And so what's this big conspiracy theory online is that people, large financial institutions, are buying real estate, buying land, buying whatever. We can see them do that right now. That is not a conspiracy theory. Okay, that is something that is being seen right now. They're, or the other option is that they're shorting the crap out of Hawaiian Electric. That's not really good either, right? But I don't think that's what they're doing. I think they know how this is going to play out. And I think that they are accumulating Hawaiian Electric near a super cycle low against in the money puts that are risk free. Okay, so that's all sticking to stocks. That's all sticking to stocks, and that's not really what made me mad. What really made me mad is that some jackwagon has a website where they get paid money to do Elliott wave analysis. And in their website, first off, I mean, you click on the website, first thing that pops up is a bunch of pricing plans. I mean, I'm sure it's ridiculous. I don't even remember what the price was. It was ridiculous. It was not worth what it was for. And they had in their website, leader in Elliott wave. Leader in Elliott wave. Wow. Really? Leader in Elliott wave. I know who this guy is. This guy knows who I am. We've been, communicating for a long time. Leader in Elliott wave coming from this guy, man. And I just want to say that, look, I've gotten them wrong. I'm trying to tell a story right now with NVIDIA. I'm not trying to say, I got NVIDIA right, that means I'm infallible. All right, I've gotten plenty of them wrong. I've gotten plenty of them uncannily right, by the way. But there's someone right now. They've got, around this time, in March or April, the second quarter, right around here, they were saying that NVIDIA and all these tech stocks, right? Microsoft, Apple, whatever, bloated pigs, going to zero, whatever. At that time, me and this person had the same amount of Twitter followers. The same amount. And this other person too, he had more than me. This guy who says he's the leader in Elliott wave, he had more than me. He had much more than me. Their Twitter accounts have exploded. And I'm not trying to whine, okay? I'm trying to make a serious point here that's about the stock market, okay? This is a business for a lot of people, and you got to get that. That's rule number one. That's really rule number one. This is a business for a lot of people, man. That's what you have to understand. And when I started this, a lot of people said, if you don't charge people money, they're not going to give a fuck. They're not going to care. And they said that all the gurus who did this, right? All the gurus who did this, the reason that they said they charged money was because if you didn't make someone pay money, they were never going to value your work. And I was just like, no, that's crap, right? That's just not true. And I'm not saying that I'm perfect or anything like that. I'm saying comparatively, I am leagues and mountains away from these people. I am in the stratosphere ahead of these people. Okay, they're not even on the same level as my kids. If I had kids today and they popped out of their mother, their kids, my kids, would be better wave theorists and investors than they are. But this is a business to them. They don't care about how good they are at investing. They are running a business. The financial media is running a business. The gurus are running a business. And that is not to whine. That is not to say that because there are gurus who are bearish, the stock market's going to go up. That is not what that's saying at all. Okay? The bigger point would be that they had no plan for this in semiconductors. And maybe just to be a little fair, let's just go to SOXX, right? SOXX, the NASDAQ, they ain't got a plan. It's not even that they were wrong that it happened. It's that they didn't even have a plan for it. What's the plan? The whole short position just gets wiped out, right? That's reality. All right, there's a South Park episode where reality comes to you, ruins the party. That's reality. Is that you short semiconductors in this area and you just say, oh, the gurus are going to get F'd. You buy puts, you do something that all these people are doing, And you do that, you're done. You don't have a short position to talk about. You don't have a position to talk about. You have to keep working to get another paycheck to buy more puts. Okay? That is what you have to do. They weren't talking about premium collecting positions. They weren't talking about hedging with credit spreads. They weren't talking about hedging with cash secured puts. They weren't talking about anything. Long gamma positions, nothing. Nothing. And you know what? This guy said he was the leader in Elliott Wave, and I was just thinking, you know what? He's right. He's right. He's right. He is the leader in Elliott Wave. He is the leader in Elliott Wave. Because he is going to get more out of this. He's going to get more out of this than he lost from this. Right? These gurus make more money. This is what you have to understand. These gurus make more money in these 2-week periods 100-fold than they lose in this period. Okay? They can be bearish this whole time. This whole time. Shorts, puts, even leverage, even short futures, doesn't matter. Doesn't matter. They can say that's their plan. I'm shorting futures. I'm shorting, I'm buying puts. I'm loading puts. And they can just get wrecked. And the positions that they don't even really have, that they acted like they had, could evaporate to nothing. And you would think that would destroy their credibility. It doesn't. It doesn't. You need to understand they will make it all back in tenfold from this. That's their investment. And it's not wrong. It's not necessarily wrong. But that's the first thing to understand. It's not just me. It's not just me. Look at the people I follow. A lot of them, that just post regular charts. You know who I'm talking about. The ones who don't have discourse that I follow. A lot of them don't follow me back because I'm too controversial. I get it. But the ones who I follow, I don't want to even say their names because, but I respect a lot of them and they're good. They're good. They got 5,000 followers, 7,000 followers, 10,000 followers. They're good. You know what I'm saying? I was just thinking, man, this dude is the leader in Elliott Wave. Right? And that person, the other person, they just made their whole profile short. It's just all of them. Even the people who call me broken clocks, even the trolls, I click on their profile and every single one of them, do you think we're stupid? Every single one of them, the trolls, the gurus, all of them, they have some pinned tweet up there that says, this won't end well. I sent a risk off signal. I sent my first risk off signal ever. Right here. And they got a pin to their bio, whether they're a guru or whether they're a troll, and they'll call me a broken clock. You go pick on their, and really? Oh yeah, that was the first time you ever said anything bearish. That was the first time. Get the heck out of here. But it doesn't matter because they're running a business, and I'm not even mad about it. I'm saying that was the most important lesson for me to learn. Seriously, that was the most important lesson for me to learn by far. They're running a business. It's not even a bad thing. But if someone is listening to them and in fantasy land where all these blown out positions just exist and they didn't even post stops, they don't even talk about gamma, how could you be you're a short and you don't even talk about hedging your positions with call gamma? Really? You tell me there's one professional bear in this market that shorts and that actually knows what they're doing, and they're not hedging with call delta. If you believe that, there are igloos in Texas that I gotta sell you right now. All right, so I don't want to just be. All right, and you guys know what B stands for. All right, I don't want to just be. All right, I got a little bit of a solution. I got a little bit of an objective solution. All right, I've been studying markets. I've been studying technical analysis a long time. I've heard a lot of gurus. I've heard a lot of people, no one's ever predicted the market more uncannily than me. That's for sure. But I've heard a lot of gurus say they call the tops. They send out their first signals. They sent out their first signal, November. All of them sent out their first signal January 1st or November 21st. All of them. It's amazing. Not one person was bearish before late November to early January in 2021. Did you know that? And they're actually still holding short positions from here that they're still making money on. They didn't short Microsoft, Apple, or Nvidia, or any of the other stocks that made all-time highs. They only, and they're still shorting. They're still holding the Q. I mean, that's the type of crap that I'm arguing with. So what I'm going to say, the only one I've ever seen consistently do it is the bar chart trend seeker indicator on the NASDAQ weekly. Only one I've ever seen consistently do it. That's it. That's it. Never going to get better than that. Never going to get better than that. I got 9 years observing the market. And I don't mean like observing the market. I mean like, close to a decade now. For the past 6 years, it was like grad school level of education, ultimately culminating in my retirement. And in 4 or 5 months, my wife's going to be ready to retire too, right? Beyonce, I should say. No one's ever done it better than this. Bar charts, trend seeker indicator on the weekly. Only guru, I believe, got bullish here, got bearish here, got bullish here. Only one on earth. Only one on earth. It says it's using the underlying instruments, volatility, historic volatility readings, I believe. It's using Elliott Wave and something else. But it's using a combination of Elliott Wave and the underlying volatility to determine when the trend ends. Basically, green means go. Green and red is kind of like the yellow light. Red only is the stoplight. Pretty simple. No one's ever done it more consistently better than that. As far as calling the market goes, as far as quanting the market goes, I'm very interested in a new ETF called CONY, the Yieldmax covered call ETF, CONY. It's brand new. Literally dropped Tuesday afternoon, or Tuesday or Wednesday. So I'm taking a position that is 1/3 Coinbase and 2/3 CONY. So it's important to understand what these ETFs. A lot of people don't understand what these ETFs do. They're holding 95% cash and equivalents. This is a summary of how I understand it. Okay, this is a pretty complicated option strategy they're running, but the main gist of it, the skinny of it, is they're using a synthetic covered call strategy. That's a fancy way of saying that they're buying an at-the-money call, they're buying an at-the-money put, and they're selling an at-the-money put. So we can look down at their holdings right here. It appears, if I'm reading this right, that they sold the 75 put on Coinbase that expires 9/15, and they bought the 75 call on Coinbase that expires 9/15. So what's that do? That gives a position that has a delta of 100, which is the same thing as having a delta 1 position. It's essentially owning 100 shares of stock, right? That's the delta equivalency. So there's other aspects to this strategy. They're selling, the big thing is they're selling a naked put, right? They're selling a naked put. And so, and then what they're also doing after they create that position, that as far as delta equivalency goes, is the equivalent of owning 100 shares. What they're then doing is they're selling out of the money covered calls. They're called synthetic covered calls when the actual shares aren't being held, but it's in synthetic option position. They're selling short-term out of the money calls, right? So they own the 75 call on Coinbase. They're selling the 75 put on Coinbase. That gave them a position that was the equivalent from a delta perspective of being long 100 shares. And now what they're doing is they're selling out of the money calls on Coinbase. So notice that this call is pretty out of the money. So a lot of people say that the problem with covered call strategies is that, they're covering too much of it. We can see right now, the only thing that's being covered, that appears to be being covered, and I might, if I do download all holdings, I'm not sure what that would do. I'm not sure if that's going to ruin the video. We'll see. It might. Let's see. Anyway, it appears that the only holdings that they have right now, which are subject to change, is that they are buying they own the 75 call, they're selling the 75 put, and then they're selling an out of the money covered call, the 84 call that expires on Friday against that position. So Coinbase, if this is the only option that's being sold, and I'll check after this, then Coinbase has to go above 84 for them to be missing out on upside. So even with that, I'm still making sure I'm not going to miss out on Coinbase's upside because a third of the position is Coinbase itself. 2/3 of the position is CONY. The reason that I'm excited about this is because this, of all the Yieldmax funds, is going to have the highest implied volatility, and option premiums come from implied volatility. So that's why Tesla and OARK and CLIP, the Chinese tech ETFs, pay the highest yields because those ETFs have the highest implied volatility. So that's not a free risk to take. That's not a free trade-off. Can't just go start selling out of the money covered calls on, stocks with high implied volatility and, make a living, right? So there's, it's a risky strategy, but it's one that retail traders have not had access to for a long time, and it generates a lot of income. So Coinbase, CONY might not even pay an ETF, might not even pay a dividend this cycle, but I'm still expecting in the long term it's going to pay on average a higher dividend yield even than Tesla and OARK and CLIP, because Coinbase should have the highest implied volatility over time. I believe Tesla's implied volatility right now is Tesla and Coinbase, last I checked, have IV rank close to 0. Tesla's might have changed, at least as of yesterday. Tesla's implied volatility rank was close to 0, or on Tuesday. Coinbase's implied volatility rank is 0 right now, and the implied volatility is 74%. So, even with implied volatility being at its 52-week low, we can still see that Coinbase's implied volatility is very high. That means over time, these option premiums should be very high, unless Coinbase just completely gets obliterated to 0 the moment I buy it, right? If it doesn't, then I really just need Coinbase to kind of stay afloat for a year and a half, 2 years max, and it's going to pay for itself most likely. I think it actually could do better than stay afloat. So from an Elliott wave perspective, I think, one aspect of it is that we get these fibs out from this high. Coinbase looks something like this, A, B, C, and then it's ending this, ABC correction from this all-time high, right? Ideally. So this is an ABC correction. And from this low, I suspect Coinbase has formed a wave 1 and a wave 2. So we're going to talk about other ETFs in this, we're going to talk about other stocks in this sector, like MicroStrategy, like Mara, like Riot, like Bitcoin itself. But just looking at the weekly chart right now, what I think could be happening for Coinbase is that this is wave 1 and an ABC wave 2. Wave C ended right where the length of wave A, place of the wave B high, was reached. From this low, this is another wave 1 and another wave 2. So the 78.6% retracement is 60.98. Okay, so I'm gonna have kind of the buy the dip mentality and kind of accumulate Coinbase over time. All right, I've taken a starter position, and then a month from now, 2 weeks from now, if Coinbase keeps falling, I'll add, and even if Coinbase starts to recover, I still might add. So I'm really scaling in over time, and that's especially useful for something that's designed to pay an option premium each month. So there's kind of a little bit of an indirect hedging with the covered calls that I'm getting from CONY on Coinbase. So 1/3 of the shares are Coinbase itself, just to make sure I capture that upside, because Coinbase will have times, I'm suspecting, when it goes and runs past that strike price above 60.98. This is a pretty deep kind of correction, and that's usually not a wave 1, wave 2, wave 3, wave 4. I think this is wave 1, wave 2, and then this is another wave 1. There's an old saying, wave 4 retest the wave 1 high. It doesn't, destroy it down to the 61.8% retracement. I think this is another wave 1 and another wave 2 above the 78.6% fib of 60.98. What I'm expecting in the long term is that Coinbase is going to go enter up into a wave 3. And so that would be kind of the next phase. And then if I, held this position and it got remotely close to 120, then, there would be bigger, option premiums for CONY to collect. And if we started flagging up here for wave 4, I could keep collecting premiums during the consolidation, which is kind of what I'm doing with Tesla and Tesla right now. The bears say that, those are going to crash. So, that's not what I'm doing, but I think that is what I'm doing. We can talk about Tesla and the NASDAQ at different time. It's really just crypto for this video. So really the idea is that over time, a projection for Coinbase could be something like this, right? And if I held CONY and Coinbase during that time, CONY would really start paying for itself, a pretty good amount by this time, especially if I kind of reinvested, the dividends during this kind of wave 4 bull flag. So that's Coinbase. Here is Marathon Patent Group. I think Mara from this low. Riot. So we look at Mara right now. What we just talked about with Coinbase is that this deeper correction a lot of times is not a wave 3 and a wave 4, and usually, especially when you get past the 61.8 to 78.6% retracement, that's also not a wave 4. So a lot of times people will ask why I'm talking about a wave 4 ending when they think it's a wave 2 ending. Well, in Elliott wave theory, every single time a wave 4 ending is going to be a more conservative prediction than a wave 2 ending, right? So the silliest thing someone can do is get on FinTwit and argue if a wave 4 is ending or a wave 2 is ending, right? But the deeper the correction goes, ideally the more likely it's a wave 2. Okay, so for Marathon Patent Group and Riot, let's just talk about, I want to talk about the wave 4 idea with Mara, right? Which kind of, the deeper this correction gets, looks a little more silly. Let's talk about kind of just the overall count. From this low, pretty clear, 1, 2, 3, 4, 5 waves, right? So the debate that the bears are going to say is that this is 1, 2, 3, 4, 5 waves. So we're looking for a deep wave 2 correction, right? So what's the problem with that? Well, in Elliott wave theory, there's a rule that says within the same cycle, if we have a new high on the relative strength index, a wave 5 has not occurred. And if we look, usually wave 5 isn't the biggest wave, wave 3 is the biggest wave. And if we look at these waves, what we're calling wave 3, it is clearly the biggest wave. So the bears are calling wave 5 the biggest wave, okay? And that's kind of the problem with the bear argument. So what's it more likely? Well, in my opinion, I wanted to really talk about Riot. But what is more likely is that it's something like this, where this isn't, yes, a wave 3 and a wave 4, because we're having this deeper correction. I suspect it's actually another wave 1 and another wave 2. So I'll say right now, I'll probably say it many more times, Bitcoin being above the level I'm going to talk about is the most important invalidation for this kind of next view across crypto. Mara right now, the longest invalidation, the biggest invalidation is 8.45. That's extremely wide. Okay, even for 8.47 this low would invalidate that this is the wave 1 and wave 2, because one of the laws in Elliott wave theory is that wave 2 can't break the wave 1 low unless it's a recent IPO, which Mara is not. Okay, so that's the biggest invalidation. It's 8.47 and 19.88. So that's the biggest invalidation. 10.91 is a little tighter, and there's a potential that Mara does not enter wave 5. It enters wave 3 of wave 3. So the distinction between the counts is important to understand that it's not really an important distinction until or unless Mara gets back above 19.88, right? It's not really an important distinction until Mara gets back above here, right? So that's Marathon Patent Group. The MicroStrategy is another one, very similar idea. Wave 1 and wave 2. So the debate, what the bears are going to say, this is 1, 2, 3, 4, 5 waves. So that's going to look for the end of a 5-wave sequence, and they're going to look for a deeper wave 2 correction. What the bulls are going to say is they have kind of two arguments. The first is that within the same cycle, just like Mara and just like Riot, this is the highest RSI reading, suggesting it's not within wave 5, right? A wave 5 has not occurred, right? So this is wave 1 and wave 2. I think this is another wave 1 and another wave 2. This is wave 3 and wave 4. So it's still a deep wave 4, but above the 78.6% retracement of 310, we can see that this is going to make another high for wave 5. So wave 5, and remember, wave 5 is always going to be a more conservative expectation than wave 3. The length of wave 1 placed at the wave 4 low can take MicroStrategy up to 500. And with evidence from Bitcoin and other crypto mining stocks, we could see, that this evolves into 1, 2, 1, 2, wave 3 of wave 3 as well. So that's MicroStrategy. They're not going to make any of these easy, but that's kind of what the count would suggest, is that it's not going to be easy, but it'll be worth it. From an Elliott Wave perspective, that's what's being suggested, and Bitcoin is really helping to kind of define that risk in the short term. So again, I don't think it would be the end of the world if Bitcoin went below 24.815, but it's important to understand that would invalidate the idea that this is a 1, 2, 1, 2, wave 3 of wave 3 occurring, because in Elliott Wave theory, wave 1 can't break the wave 2 low, right? And so what's the argument is that this is the next. Kind of very similar to Mara, very similar possibly to Riot as well, that they're making this difficult because it's a big opportunity, right? And so Bitcoin above this wave 2 low of about 24,815.78 is going to invalidate that. Now, let's play devil's advocate. And what if Bitcoin breaks that low? Well, from this low, it's still 1, 2, 3, 4, 5 waves up. So what the bears are arguing is that this is not 1, 2, 1, 2, wave 3 of wave 3. What they're arguing right now is that this is all wave 1 from this low. And so we're looking for a deeper wave 2 correction, right? Now, if Bitcoin does get down here and has this deeper wave 2 correction, are the bears going to say, yeah, this is 1, 2, 3, 4, 5 waves up. We had a deeper correction, and now we're going to explode? No, I don't think they're going to say that. But that's kind of looking down the line for Bitcoin, for DuckDuckGo. So above that wave 2 low, Bitcoin can begin a rally towards 38,000 for wave 3, and even beyond that. Now, Riot blockchain is a very interesting one. We look at Riot right now. Someone pointed out, that Riot didn't really fit the criteria for entering a wave 3. Sorry, for entering a wave 4. If we look at Marathon Patent Group and Riot and Bitcoin, Riot's also kind of supporting the idea, again, with kind of, a meaningful invalidation that's getting closer and closer to not being very far away. Riot can support the idea with this really deep correction. And also, like the rest of them, that within the same cycle, this is the highest RSI reading on the daily chart within the cycle from the late 2022, early 2023 low, 5.18, 5.16. We can see that Riot, could also be a nest. Now, and that's the problem with the nest, is that it just kind of looks too bullish, right? What do these cryptocurrencies do? They kind of do things that sound like they're going to be a little too bullish before they happen, and then they do even more. Okay, so what's the bear argument for Riot? Bear argument for Riot right now is that this is 1, 2, 3, 4, 5 waves. So we just ended a wave 1, and I'm retail Furu, and wave 2 is not gonna end till down here, right? If we do get down here, they're not gonna say that's a wave 2 ending. But it's important to understand that there's a huge possibility right now that above 9.42, this isn't 1, 2, 3, 4, 5 waves up. We make this new high on the weekly RSI reading. We've got this deep ABC correction. Another way to define the risk would be that this is wave A, this is wave B, and so now we're getting right there. The length of wave A placed at the wave B high is where wave C ends. So the most meaningful invalidation for Riot is going to be this low right here, that red wave 2 low. Now, I'm not sure how far away that was. For Riot, that may not be very far away, but above 9.42, I think it's one of these that's suggesting they're making it difficult because the account, and really in the big picture, right, if this was some type of, count that sent Bitcoin and Mara and Riot, towards all-time highs, right, the big kind of bull thesis is this is in the big picture is all wave 1 and a wave 2. That's going to sound way too silly right now, right? Bitcoin, same thing, wave 1, wave 2. So if they are building up kind of a coil to explode into wave 3, this is how they make it difficult. They had options, implied volatility rank, right at 0%, those lucky MMs got implied volatility rank, and they've been buying straddles and strangles. I think MicroStrategy and Mara, both of them, Riot may not be the best example, but Mara and MicroStrategy, those lucky MMs got 0%, implied volatility recently. I talked about how Bitcoin and BITI and BITO were all over those ETF screeners, so they've got options to buy shares against. I think that, Riot and Bitcoin, but Bitcoin especially holding those wave 2 lows, we can see that the reason they're making this difficult is because in the big picture, what's going on, in my opinion, is that Bitcoin is building up energy to begin a long-term wave 3 that ultimately says this was 5 waves up, wave 1, this was wave 2, and if this wave 3 does take place, and it does eventually end up taking Bitcoin to all-time highs, that's kind of it, right? It's going to be like those charts of tech where, it made that low in 2009, it made that low in 2011, and it never looked back, right? Now people are, now the dips that we're seeing and, Apple and the NASDAQ and, a lot of those semiconductor stocks, they're nothing, from a price point of where these valuations used to be. In the big picture, I know it's hard to believe, right? But could this 1, 2 one day look like this 1, 2, right? Could it one day look even like this 1, 2? Right, that's the reward above this wave 2 low of 24,815.78. That's the risk.